Hello traders, welcome to Investoo.com's introductory guide to stock indices. In this lesson, I'm going to show you why we like to trade stock indices, why we think they can be profitable, and how they can be extremely profitable for you if you learn how to trade them correctly. And to do so, we are going to go to this page, and the sector or the of the page that I want you to focus on is here, trading conditions. Above its trading conditions, you can see that we are looking at the E-mini S&P 500 futures, and right here you can look at the contract description. But this is the part that I want you to focus on, all right? The minimum price fluctuation. This means that one tick on the E-mini S&P 500 is a 25-cent move on the index. And if you are trading one lot, then one tick equals to $12.50. This means that if you are trading one contract on the E-mini S&P 500 and price moves 25 cents in your favor, you are going to make $12.50. Now, if we go to the Dow Jones, you can see that we are looking at the mini-size Dow Jones futures. Here is the contract description, and right here the minimum price fluctuation is $1. This means that on the Dow, one tick equals to $1, and if price moves in your favor $1 or one tick, you will make $5. Okay, this is very important. Each and every single one of these future contracts on stock indices have different tick values and different minimum price fluctuations, and that is something that you need to learn. But let's stay with the Dow Jones with a minimum price fluctuation of $1, which means that one tick is $1, and the tick value is $5. And let's go to the charts. And this is why we love trade these stock indices. Now let's go back to the 1 hour chart, okay, and let's look at today's price action. And let's imagine that, well, you wanted to trade the breakout out of these, and this is just an example, guys. You wanted to trade the breakout out of this zone of resistance. No, let's assume that you are trading this zone of resistance. Much better example, okay? Now we are going to draw a line right here. You can see that this was tested once, twice, a lot of times, and you decided to go short right here when after this candle, when this candle breaks with the previous low. All right, so you have the sell stop around this level. This is where your sell stop is going to be. This is by no means a video on how to trade the Dow Jones. This is a video on how profitable it can be for you. Okay, now your stops are going to be above the previous high. Logical and usual stop placement. This means that your stops are going to be at the 17.85.2 level, and your entry is going to be at the 17.82.7 level, which means that you have a 25 pip stop loss, or a 25 tick stop loss. And because we are just day trading the Dow Jones, we are going to be targeting this zone of support, okay? Which means that we have a target of around 115, 116 ticks. And well, this gives us a better than a 1-to-4 risk to reward ratio on our trade, all right? Or now let's calculate money values right here. With a 25 pip stop loss and a tick value of $5, this means that we are going to be risking on one contract $125. Now let's calculate the reward on this trade, which means that we have 116 ticks to our target that got hit times $5 per tick, which means that we are going to be making $580 on this trade. And this is why we like trading stock indices, and this is why you should learn how to trade them, because not only you can get very good risk versus reward on your money, but you can also hit your target within one trading session. if you are day trading. And of course, if you are swing trading, your stops are going to be wider, but your reward is going to be also bigger. But you get the idea. Stock indices are a very good earner for a day trader